The US and China agreed the terms of a Phase 1 deal as the two sides look to move beyond their trade tensions. But with the Chinese economy gradually slowing every year since 2009 and concerns about the level of domestic debt, will the trade deal be enough to boost China's economy in 2020? Joining me to discuss the outlook for China in the new year is Nick Parsons, Head of Research and Strategy at ThomasLloyd. Nick, good to see you. I mean, how significant do you think this Phase 1 deal is in terms of thawing relations, and what could it mean for China's economy next year?
Well, I think it's certainly helpful. We don't yet know the full details of it. There was a report on Reuters a couple of days ago which said that the actual agreement runs to 86 pages.
Wow.
Now, we've only seen from the US side a 2-page summary, and we haven't seen anything from China which discusses figures, hard numbers in any respect at all. So at the moment we're asked to take it on trust. It's thought that there's going to be a signing ceremony sometime the first or second week of January. But for the moment, nobody's seen the full 86 pages. So we're trying to second guess what might be in it according to various press reports. I think it is helpful because what it does, it removes that worst case. And that worst case is that we would see an escalation of trade, tit for tat, retaliation followed by further measures and escalating into something which would really lead to a full-scale trade war affecting the entire globe. So the great news is we've taken away the downside. Whether or not this is enough to sustain the positive momentum in asset markets remains to be seen. But for the economies as a whole, I think we can take this as good news. If this was a sports game, we'd say it's a score draw. And then each manager would go out looking for the positives. So I don't think it's a clear win. I don't think it's a clear defeat. But it's probably the best that we could hope for was a score draw that leaves everybody looking for positives.
So we know that obviously China's been facing this gradual economic slowdown for 10 years basically now, since 2009. I mean, what are you expecting for the year ahead in terms of its growth?
I think a continuation of that slowdown looks to be in prospect. Over the last 20 years, China's growth can really be taken in 3 phases. We had that period up to 2008, when of course we had the Olympic Games in Beijing. In 2007, the Chinese economy grew a remarkable 14.2% in the year. So we had a really big increase in infrastructure spending and investment spending. Factory output surged, and we had the Olympic Games. They gave all the messages to the world that they could possibly have wanted to deliver. From 2009 to the present day, we've seen a slowdown where growth has averaged something like 7.6%. And the IMF, I think have got a pretty good handle on these things. The IMF's forecasts are for the next 5 years, it's going to grow something like 5.7, 5.8%. So a gradual slowdown, continuing the slowdown that we have seen. Let's bear in mind though, and I know we've talked about this before, that China's economy is 14 trillion US dollars. So if it's going to grow, say, 6% next year, which seems to be the consensus view, 6% of 14 is an $840 billion increase in GDP. Now, by way of comparison, we're just throwing big numbers out here. What does it mean in real terms? If there was an economy that generated 840 billion of GDP, that would be the 17th largest economy in the world.
Wow.
So just the increase in GDP that we're seeing is itself remarkable. So we've got a slowdown, but 6% of a very big number is still a big number.
But I mean, how concerned do you think we should be about the levels of debt in China? Because we've had a few warning signs from some of the ratings agencies like Moody's chief economist saying that Chinese corporate debt is the biggest threat to the global economy. Fitch kind of echoing that view, saying that private companies have defaulted at a record pace. You're talking about those large numbers. If we flip it on its head and think about if there was some kind of a catastrophe, that could be devastating.
Well, I think the experience of GFC in 08 and 09 taught us that if there are problems with debt, it's important to have a backstop. It's important to have someone who can absorb that debt, who can then work it out and work it down and run it down over a period period of years, and someone who in the meantime is able to provide finance where it is most needed for businesses, for consumers and all the rest of it to keep a market economy functioning. And at the moment at least, China does still seem able to have that capability. Let's remember, this is not your normal market economy. This is a state-driven, state-led economy, and as long as it has both the capacity and the will to provide that finance, then I think those worries are still going to be very much in the background rather than at the forefront of investors' minds. Because if anyone had ever thought 5 years ago, let's take another example, that there could be $14,000 million of negatively yielding bonds across the world, they'd be laughed out of the room. And that's where we were at one point this year, $14 trillion of negative debt. So we kind of have to think the unthinkable when we look at these numbers and say, well, is it really possible that the Chinese authorities and the Chinese central bank could take on that amount of debt? Well, given that we've had to think the unthinkable for markets, then I think the answer is probably yes, that they can. Where there's a will, there's a way.
Now, you mentioned asset markets before. When we think about the performance of the Shanghai Composite, it's up by more than 20% so far this year. Pretty impressive performance. Are you expecting the same for next year?
We're not expecting the same, but then we're not expecting the same across all major markets. Yeah. The Shanghai Composite up 24%, the Nasdaq up 26%, the S&P up 25%. If we look in Europe, the Stocks 500 or 600, I forget where we are these days, but the Euro Stocks index is up 24%. And even given the election result last week, it's given that boost to domestic markets in the UK 250 is up 24%. So really, what we're really seeing here is global stock market movements. Right. So 24% of China, 24.6 for the US, 24.5 for Europe. We're all pretty much there. Frankly, I think it would be difficult to see double-digit gains in 2020, but equally it's very difficult to see the drivers and the catalysts for a decline of more than 10%. So at the moment, a bear market doesn't seem likely. That's not to say that we're not at the mercy of events, but a slower pace of growth, a slower pace of corporate profits, that probably leads to a slower pace of asset market appreciation. But 2020 doesn't seem to be, at the moment, the year in which it all falls apart.
So the IMF had this forecast that said that China's economy is likely to actually underperform the Asian region over the next 5 years. So does that mean it's time we should be looking beyond China's borders to some other economies? And if so, which ones?
I think that's a really good point, because the IMF groups the 30 countries in Asia together. And whereas China's expected to be at 5.7 for the next 5 years, the rest of Asia is still 6.1. So it's a real crossover. This is the first time this has happened in more than 20 years. So those countries that are going to grow are those with strong population growth. And here we could look at countries such as Indonesia and the Philippines, and India to some extent as well. The population of Asia is going to increase over the next 30 years by over 500 million people, according to the United Nations. None of that population growth comes in China, interestingly enough. So it's India, it's Indonesia, it's the Philippines. The Philippines has got 100 million people at the moment. That's going to add another 45 million people in the next 30 years. So countries where there's strong population growth, countries which still welcome overseas inward investment, countries which have got a strong rule of law, and therefore you can have some certainty that once you put your money in, you'll be able to get it back. So the countries that we would favour are really the Philippines, Indonesia, Vietnam is coming up strongly on the rails if this were a horse race. So those countries which have got a demand for foreign investment, which value and recognise the difference that it can make, and have got a rule of law and an acknowledgement of the needs and aspirations of overseas investors too. So I think Asia is going to be a very exciting place, not just over the next year, but also over the next decade.
Nick, thank you so much for your time.
You're welcome.
That was Nick Parsons from ThomasLloyd. I'm Victoria Scholar, and thanks for watching IGTV.